My name is Antonio DiSombrino, and I am the Vice President of the Advanced Risk Management team. What we're going to be doing today is looking at a short video that showcases a software we use for our clients to help stress test their situation and look for any areas of risk that need to be mitigated. So let's just dive right in. I want to show you our software that we use. In this software, we're looking at a forecast model starting in 2020, going out to 2050. And this can be extrapolated out as far as we need or bring it in shorter if needed. But before we jump into the actual forecast, I want to show you the inputs that we put in so you have a better understanding of what this is based on. So for these clients, it's Earl and Joyce at 70 and 69. But this software isn't just meant for our clients that are retired. It also can be used for our clients who are in their 30s, 40s, and 50s, accumulating assets and wanting to see what their future retirement might look like. When we start off by inputting the client's income. And this could be work income, Social Security, pensions, investment income, rental properties, what have you. So we input the client's income. The system also takes into account survivorship of the income if one spouse predeceases another, as well as inflation. We also input all the client's assets, and we can put in future inheritances as well. We also put in whether or not the investments, their allocations, how they're split up, whether it's mainly in bonds, mainly in stocks. We add those allocations in on this page. This client we put in as a 60-40 allocation between equities and bonds. But we can also make this whether it's 70-30, 90-10, or we can put in your actual individual account positions. If you own Tesla, Apple, any positions whatsoever, we can put it in there, and the system automatically takes into account past performances and can also extrapolate out a future for those individual positions. We also input the client's life insurance, long-term care, liabilities, as well as the client's expenses. These expenses up top are the expenses that we lump together, tend to be things like your utility bills, auto insurance, property taxes, things of that sort. And those usually increase a little bit over time. The system allows us to adjust inflation as needed for those expenses, as well as it figures a survivorship goal. Should one spouse predecease another, how much would these expenses potentially decrease by? We can also put in a lot of what-if scenarios. What if there's a long-term care event, a disability, travel expense during retirement? For our younger clients, we could put in things like, what if there's increased college expense or auto insurance expense for X number of years? We can input that as well. We could put in things like the mortgage payment and when that drops off after the house gets paid off as well. So all those things calculate out to create our forecast, and what we're looking at is the forecast of the client's cash flows over time. When we initially come to a screen, in this forecast screen, we want to see exactly what we're seeing here. A very healthy looking forecast. If any of these bars were in red, that would mean that there's a shortfall of income, and right on the onset there'd be some figuring we would have to do to help make sure that there's no situation where the client ends up running out of money in retirement. Also, looking at a 97% income stability ratio is a very strong indicator for this client that the vast majority of their expenses are covered by their fixed and guaranteed income, as opposed to having to draw down on investment income to a significant degree, which could create problems throughout retirement or even just anxiety for the clients. Current assets, 1.8, almost $1.9 million, and this is showing a projected legacy over time of those assets growing to about $9.2 million. Again, that is a factor of their income being a lot more than their expenses, and they do not need to draw from their investments in order to cover their day-to-day living expenses, allowing their assets to grow over time. So when we look at the client's balances, we can see how their assets grow over time as the years go by. And assuming that one client lives to 96, another to 99, that shows where the projected legacy is close to $9 million. Now, within this scenario, we can start taking a look at different factors as well. We're looking currently at an average market sequence, meaning what if the majority of the years are positive with a few negative years in there? So that's the sequence that we're looking at. But we can also change it to say, what if the markets are more bullish and much more positive than what we were just showing in the average sequence? So this shows a lot more positive years and very few negative years, and obviously we can see the legacy number just increases. But we can also go to the opposite end of the spectrum and say, what happens if the market is far more negative, more bearish, and less bullish over the years, and the average rate of return is a lot less? So again, in this scenario for this client, it's only affecting the legacy, it's not affecting their cash flows. But we can also throw in scenarios to say, what if one spouse lives much longer than the other? and one spouse predeceases the other much sooner than expected. We could see how that scenario plays out for the clients as well, just by using these slide rules below. We can also take a look at tax sequence, and in this scenario I have their current tax bracket at about a 15% tax bracket, and we also calculate in the years where they have to start taking required distributions and their income increases, taxes going up. And we can also take into account what if, depending on who's in the office and the administration, whether or not income taxes continue to increase over time. We can also take those as scenarios, negative market sequence, increased taxes over time, and what if inflation increases a little bit as time goes on? So now we've added increased taxes, increased inflation, as well as less than favorable market conditions. And we can see how the legacy number has been affected. We can also take into account the client has mentioned that in their 70s and 80s they would like to travel more and spend some more time with the family and even pay for the family to go on cruises and trips. So we add another $20,000 a year of travel expense. From a cash flow perspective, their scenario can handle it. Asset-wise, we could see again where the markets are less than favorable and inflation increases, taxes increases, and they're having this travel expense. Obviously, it's having an impact on the legacy. But we also throw in the scenario as far as having a long-term care event, and these clients in particular do not have long-term care insurance, and we could see how that might impact the scenario. So you can see we're using a lot of these risks in culmination together to see how many of these risks can their scenario handle. This is the stress test. So now we can see that it actually has a much bigger impact on their legacy if they travel from 70 to 80, and if one of them have a long-term care event that happens around age 84, the markets being less than favorable, as well as a little increase in inflation, a little increase in taxes. This is showing that there is a shortfall of income that would need to be mitigated if possible. And we can see their balances over time slowly coming down. So in this scenario, again, I'm going to go back to average market scenarios, average inflation. We're going to go back to no long-term care event and just travel. And we can see again $8.4 million of potential legacy. And we can also drill in deeper to take a look at how these balances fluctuate over time, as well as their cash flows, where they're deriving the income, where they're taking the required distributions, income, taxes, expenses, and what their surplus is, if there is a surplus. So it's a very robust software. It allows us to do a lot for our clients, allows us to do a lot of stress testing for our clients. We like to do this at least once a year for our clients. It is a free service that we offer, but we can do it as often as the clients need. All you have to do is just let us know. So that's the software, and that's what the Advanced Risk Management team does for our clients. And all of our clients that we've done this for have told us how informative it is, and that they really appreciate us doing this for them. And we look forward to doing this for you as well.